Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
So we're back here to talk about commercial and residential. We're going to compare and contrast. There is a theory that there will be a real estate crash. That I think it's possible, but not residential. I think we're beyond that. I think potentially commercial. We're going to talk about how this could affect residential, but there could be some problems in commercial. We'll go into those specifics. But what I wanted to point out was Juana is wearing the $1 yard sale dress. Somebody who has sold over 2,000 houses, probably valued over $600 to $700 million worth of real estate, right? And that's like a lot of houses, or more than that probably. And here you are in a dollar. I think you wore this like a month or two ago, didn't you?
Yeah, I did. I like my dress.
You like the dress, the yard sale dress? Okay.
Yeah.
So I haven't shopped in any yard sales, but I do have, I still have shirts that I wore. I'm going to go back and find like a video I did in 2009, which was 14 years ago. And I bet I have the shirt. I bet if you went back on the channel and looked at like my first 10 videos, I bet I have half the shirt still. Because I'm the same size. I haven't gained any weight.
Okay, I don't think it's about that. I think it's about how fiscally conservative we are.
Fiscally conservative. That's
also
right.
known as cheap.
That's why, yeah. That's why we can buy so much real estate. We don't spend any money on anything else, just houses.
And this is why we spend our spare time doing videos.
Okay, so we're going to talk about an article that I read about that gave some predictions about what's going to happen this year, next year, residential. And then we're talking about commercial because there's some interesting stuff going on commercial that is it's parallel, but it's not necessarily directly affecting residential. Okay, all right. So the article was where they went back and looked at all the January numbers. The pending home sales improved for second straight month. They were up 8.1% in January. These were pending. These weren't sold. So of course we know. Last month, February, was a 14+% increase. It was the highest increase in the number of homes that were purchased in like since the pandemic, right? Like 2 years.
Right.
Okay. The interesting thing about this is pending home sales increased for the second consecutive month, up from December, but the month-over-month contract signing was raised in all four major U.S. regions. So the four regions are the West, the Northeast, the Midwest, and then South, which is basically like Florida to Texas and then a bunch of states,
right.
the southern states.
Okay.
All right. Okay. NAR anticipates the economy will continue to add jobs through 2023 and 2024, with the 30-year mortgage steadily dropping to an average of 6.1% 2023, which is below what it is now, and the 5.4% in 2024. But this is just a guess.
It is a guess. NAR looks at a lot of different things, and they take into account the economy and interest rates and jobs and inventory, new construction, job relocations, growing areas, all kinds of different things. And then they sort of stir the pot a little bit and spit out a number. Right,
yeah. And, you can look at a lot of data to try to predict what's going to happen. We were supposed to have been in a recession last year. The beginning of 2022, there was a 80-something% chance of a recession, and then it went to 100%, and then we had 2 quarters of negative growth. They go, well, that's not really a recession. And then they said, no, but for sure in the first quarter, it was 100. It went back to 100% for the first quarter of this year. We're in the first quarter, and the growth numbers every month have been phenomenal. And now, it would take March to be absolutely the worst March ever. We're in March. It would have to be the worst March ever to have negative growth, GDP growth for the whole quarter. So it's probably maybe the end of the year now. They keep shifting it. They're looking at these numbers nationally, all the economy and everything, and they just keep pushing it out 6 months. So it's kind of, interesting to see why they're wrong.
Well, so they're wrong because they're trying to look at numbers and they're trying to predict human behavior. And humans are, they're consistently irrational.
Yeah, they are very irrational. They're predictably irrational.
Yes. So that's part of the reason why it's so difficult to predict these things. And of course we've had all the bank turmoil in the last couple of weeks, and that is not about to end. That is probably going to continue, and it's probably going to have a really long cycle, I think, as far as the banking turmoil. And we can talk about that in a bit. But I think that the banking turmoil will continue, particularly with the regional banks.
Okay. And we're going to get into that because regional banks are very closely tied to commercial real estate. And there's a problem. There's an actual problem there. We acknowledge an actual problem. Okay. Here's another quote from the article. With an improving interest rate environment, job gains, which is what is expected, Yun still expects annual home sales to drop 11% 2023. That's from last year, but last year was a pretty hot year, to 4.47 million units, for jumping 17.7% 2024. So we're saying it's going to rebound and shoot up to a super high number in 20. So that'll be like the hot year. Right. So based on this, the best time to buy a house would be September, October, November, December of 2023, because that'll probably be the most homes on the inventory and the least amount of people buying.
Right. I mean, I respect Dr. Yun tremendously. I just think that the volatility that he's looking at, I'm less than convinced that it's going to materialize either on the down end or on the up end. I think it'll be a much more stable market than he's envisioning.
Okay.
Yeah.
I think so too. The other last sentence here is NAR predicts new home sales will fall 3% year over year before growing 19.4%. That's a big estimate that they would grow 19.4%.
Right. Yeah.
And this is the number of sales. It's not prices.
Right. So the number of sales, I think that he's probably closer to what's going to happen because, like we talked about, we're expecting interest rates to moderate by the end of the year, beginning of next year. And, that means that a lot of people that have just kind of been sitting there waiting for that to happen are going to jump in, including a lot of sellers, which is going to open up inventory on the market. So that's going to create a lot more transactions.
Okay. Home sales activity looks to be bottoming out in the first quarter of this year. So home sales activity is the number of homes sold before incremental improvements will occur, but an annual gain in home sales will not occur until 2024.
I agree with
prices, home sales.
I agree with that.
Meanwhile, home prices will be steady in most parts of the country with a minor change in the national median home price. So he's saying home prices sales will be low, prices will be steady, and then next year, the number of sales will be more.
Yeah, I definitely think there will be more transactions next year for a number of reasons. One is because we will have gone through at that point, maybe 18 months of lower than the normal number of transactions that we would have had. So there's a lot of pent-up demand. And then the other reason is because you're looking at a lot of housing inventory where people have been in their homes longer than ordinary, so to speak, longer than average. So those homes are going to need to turn because that's just the natural cyclical nature of people as far as changing homes. So when you combine those two together, I think that's where you end up with a pop in the number of transactions for 2024.
Yeah, I definitely think 24 and 25 could be hopping years.
Yes,
absolutely hopping years for real estate.
I think particularly 24 because you're coming off of 18 months of less than normal transactions.
And I don't mean prices going up. There's some estimates in here. We're going to show you some charts, but I just mean numbers of sales.
Right.
I think there are going to be lots of transactions. A lot of people moving, a lot of back and forth. The market, pent up demand.
Right. There's going to be a lot of shuffling.
Okay. The NAR also predicts median existing home prices will be stable compared to the previous year for most markets, with the national median home price decreasing by 1.6% in 2023 to $380, before regaining positive traction of 3.1% in 2024 to $391,800. It estimates median new home prices will increase by 1.3% in 23, which is an increase, and then increase 2.8% in 24 due to higher cost of land construction materials, also a guess. They're just guessing. A lot of this is going to have to do with what builders do, right? Because they control that, don't they?
It is. And builders are still in this position where material cost is high and difficult to get materials, and same thing with labor. Labor is expensive and difficult to get, and all of that plays into builders' decision to build at all. And then when they do build, it plays into the cost that they're having to pass on to the consumer when they purchase that new home.
Okay, the next chart here, this is somebody grabbed a bunch of data from 100 experts on what they thought prices would do, and they aggregated it all. They basically threw out the high, threw out the low, took the middle ones, averaged them all in. The estimate was that for the year 2023, home prices would be down minus 1.61%. That could be up from now because this is December to December. So if we're already down 1.6%, if we're down 2 or 3% for the year, which I don't think we are yet, we're not down that much, then that means we're up for the rest of the year, which I don't know about that. But it's basically they're just saying home prices aren't going to do much the rest of the year. And then they show up 1.9, up 3.5, 4. Those last three numbers are absolutely normal market. I don't know about the next 2 years, but I think into the future, we get back to that 3, 4, 5% appreciation once everything goes back to normal, where homes just appreciate 3, 4, 5% a year, which is, and the reason I say that is because it's done that for the last 50 years, except for a couple times.
That's true.
It's just basically gone up 3, 4, 5%, no matter what interest rates have done. Okay.
Yeah.
We're going to do the next slide here, which just takes, if you buy a $400,000 house and next year it would be worth $395 potentially, right? And then 402, 417, 430, 454. So you're probably saying, well, why don't I just wait a year to buy the house? You could, sure. There's risks in doing that, right? The risks is this is wrong and home prices go up.
Right.
The risk is it gets hot again and now you can't get the house you want. So,
or simply that the house that you want won't come on the market when prices are a little lower.
Right. And you end up settling.
And then if you're buying an investment property, then you're foregoing the rent revenue, which would clearly outstrip that $5,000 price reduction.
Right. And the other thing too is now you're forced to buy at whatever rate there is next year. And if rates are higher next year, now you're buying at a higher rate. You could have locked in a lower rate now.
Yeah, I'm less than convinced that that's going to be the case.
No, I think rates will be less next year. I'm almost positive. Interest rates are pretty high historically right now. When I say historically, I mean last 15 years. Not historically, they're average to below average.
Right.
Matter of fact, I got quoted a VA rate at 5.6%.
Right. I mean, I think right now interest rates are at about what they were about 15 years ago.
Right. Yeah, I think they're about the same. So an interesting thing that also about this, couple things. First of all, remember that when you purchase a house, you're paying down you're getting a tax benefit. So if you wait till next year, you lose a year of the interest deduction.
Right.
You also lose the fact that you're paying down principal reduction.
Yes.
So that's something. Also, another thing is if you buy a VA or FHA home this year, what can you do in a year after you bought it? Because you bought it as an owner occupant.
You can rent it out
and then
get some rent revenue and go out and buy something else again.
So imagine this. You say, I'll wait till next year. I'll buy that house that's $395. You bought a house today, $400 VA. And then if you're a veteran, and then you live in it for a year and then you buy another house next year with your VA because you turned that one into a rental and you go, oh, that's a rental now. I want to reuse my VA for my primary residence, which you can do every year. You can go out and buy another house. And you can use the rent you get to qualify. So there's some benefits to doing that. Okay, there were almost no experts have said there's a crash imminent. 0 have said it. The worst absolute estimates were prices would go down 20%. Those were the worst. The best were they would go up 5%. We're kind of in this. Home prices have gone, depending in Florida and Texas, have gone up a little. The rest of our country have gone down a little. But if you're in the sort of the middle of the market, your median prices, they're sort of 3% is the number, right? And even though Redfin says 8%, in Vegas is 3%. 8% was median, but 3% is price per square foot. That's all that matters is price per square foot because that's more, realistic to what's actually happening in the market, right?
Right.
Because the mix of sales of homes can make it look worse.
Yes.
Or because what could happen is home prices could do nothing, but if a bunch of $5 million homes all sell, then it pulls up the whole thing and it makes the market look like it's higher value when it's not really. It's just
Correct.
more expensive home selling.
Yes.
Okay. So residential real estate, we've pretty much established. There's not much. We're 9 months through this. And if interest rates were really going to affect home prices, they're doing it right now. Interest rates have almost tripled from the low.
Yes.
2 point something percent. We're in the high sixes. And this is, and if you say, well, but Todd, interest rates are affecting home prices. Well, the interest rates today are giving us the home prices of today. It's not that big of an effect. The 40, 50% crash that we're going to see just never happened. It was supposed to have happened already. It didn't happen. And nobody's predicting that's going to happen. If anything, interest rates are going to start dropping. And then that blows the logic off the crashers' logic, because if interest rates go down, then home prices have to go up because they're tied that way, right?
I knew you were going to bring out the crash.
I got to talk about the crash bows. I got to do that now. But what's funny is the crash bows are completely wrong about residential, but they're not even talking about commercial. Commercial is really interesting because with regional banking and what's going on in the banking industry, there's some other problems coming about. So let's talk about this, Juana.
Okay.
What did the banks do the last 3 or 4 years when they were pulling in a bunch of money? What did they do with all their cash?
They loaned it out to everybody that they could.
Okay. But what did they do? They tried to lock in a lot of safe money.
Right. So they bought treasury bills.
Yeah, they bought these 2%. Hey, we're going to get 2% for the next 10 years. That's fantastic. Mortgage-backed securities hey, we're going to get 3% for the next 10 years, right? The problem is they're getting 3%, but money costs 5%, right? Money's more expensive now. So now they're losing money on these things, right? Because they can't sell them. They're not worth the face value. They're worth much less, okay? Now, let's add in commercial real estate, because commercial real estate's much different from residential.
Right. So commercial real estate is a big concern to us because that, for two reasons. One, commercial real estate is on a different schedule than residential real estate as far as their loans. Residential real estate tends to be 15 or 30 years. Commercial real estate has more like a 10-year window, after which they either have a balloon or the debt has to be refinanced. So that's a big concern, because when those commercial loans come due, what are those borrowers going to do? They might be in a position where the higher interest rate puts them upside down with the property, and what are they going to do? Are they going to sell it? Are they going to just kind of throw their hands up and say, "Go ahead, bank, you can have it back"? What's going to happen with that? And a lot of commercial real estate is actually not financed by the big banks like Chase and Wells Fargo and Citibank and places like that. A lot of that is financed by regional banks. Now, we've all heard a lot about regional banks lately, and I think we're going to hear more as some of these commercial properties come due with their loans and what's going to happen with that. So there is a possibility that these regional banks are going to end up with a good number of these commercial properties on their hands, which is not what they want. And then that really hurts their bottom line, and what's going to happen with that. So there is a concern, again, about regional banks and how that's going to play out. So I think that's something to really keep an eye on. Kind of in the same vein, depending on where you are in the country, we've talked about a shortage in housing, and that's a shortage in single-family homes. But there are parts of the country that have built too many apartments. So this is kind of in the same vein as commercial buildings. So they've built too many apartments, and those rents are going to be maybe not as strong as they were hoping to be. And again, they've got these loans that are going to be coming due. And so there's a concern with all of this kind of mixing together. And again, a lot of these are financed by regional banks. So that's my big concern on regional banks.
Okay, so I'm going to give it a specific example so they can understand it.
Okay.
You're an investment group, and you went to a bank and said, "We're going to buy this office building. It's beautiful. It's full of tenants. We're buying it for $100 million. It's a high rise. It's gorgeous, and we want your regional bank to finance it. Now we're going to put down $15 million, which is what you can do. You can do a 15% down. $15 million. We need a loan for $85 million to buy it from whoever owns it." And they go, "Yeah, sure. It's got all these tenants, whatever." And they go, "We're going to give it to you on a 5-year balloon. So it's, 2018 or 19. Money's super cheap. And you go out and you get this loan on this building. Everything's great. I've got 5 years to refi this thing. It'll go up in value. We'll collect a bunch of money from it, and then we'll just refi it. And at that point, okay. Now, here's the scenario. COVID happens. Everyone leaves the offices. Mm-hmm. And at the same time, interest rates are much, much higher than they were when you bought the building. Now, your $100 million building is not worth $100 million because you have half of the thing is vacant. Mm-hmm. And it's probably only worth 60, 70 million because it's only worth what you can get in rent. It's not worth on comparable values, on comparable sales. It's valued based on the income approach. Mm-hmm. You don't have any income. And you're not covering, matter of fact, you can't even make the payments on it now. Mm-hmm. And you have this balloon coming up where you have to refi it. Mm-hmm. You have to go out and get more new money. Now that bank is not going to give you the money. The regional bank, right? Why would they give you why would they refi your 85 million when the building's not worth that?
Right.
Okay. So here's the risk. The building owners go, hey guys, we blew it. This thing is upside down. It's only worth 60 million. We couldn't sell it if we want it. We certainly can't pay for the thing. Let's let that regional bank have it back. Mm-hmm. That's a huge problem for the regional bank.
Right. It's because it's not that the regional bank is just going to get back one building. They're going to get back a lot of buildings, and they simply cannot. They simply can't deal with that because what are they going to do with those buildings? They have to go back out and sell them. And what are they going to sell them for? They're going to sell them for what they're worth, which is
fire sale,
which is a lot less than what they're owed. So that they're going to have to take write-downs, and that's going to be really hard on them. So that means that they're going to have higher reserves to meet the FDIC rules, and it's just this whole snowball effect. So every time they take back a building, it hurts their bottom line in multiple ways. So it'll be really interesting to see what happens and, what, if anything, the Fed is going to do about that. And also as more of these dominoes start to fall, will more depositors get their money out of these regional banks, which of course hurts the regional banks even more. So it's just this whole cascade effect that I'm very concerned about the regional banks. And I'm not suggesting to do a bank run, but I'm just suggesting that we look at this and say, hey, what's on the horizon? How do we protect ourselves as individuals in these circumstances? And maybe, just maybe, the regulators can look at this ahead of time and try to put some things in place, because if we can see this, how can they not see this, right? How can Jerome Powell not see this? How can Janet Yellen not see this?
Well, people can see it because that's why people are saying the Fed needs to immediately start dropping. I mean, what was bizarre is even Elizabeth Warren came out on Twitter and criticized Jerome Powell for not starting to back off on interest rates because it is causing problems. And so I'm going to here's the number. This is a number that was by the he's on the Fed board. I forgot his name. There is $1.5 trillion of office space in the next 3 years that's coming up has to be refined because those are the balloon payments. It's about 500 billion a year. It's 1.5 trillion. These things are coming up. The owners of the buildings, and a lot of these buildings are upside down, even with whatever money they put down when they first bought the buildings.
Right.
And there's a lot of building owners who may just say, forget it. And, this is not, I don't think this could affect residential real estate.
Well, I disagree.
Okay.
And here's why I disagree.
Why would it affect residential real estate?
So because the Fed's going to have to make a decision. The decision is going to be, do they shore up these banks by reducing interest rates and allowing these buildings to get refinanced at something that they can afford, or do they let them go? Now, if the Fed reduces interest rates, then that accelerates inflation.
Home prices go up.
Exactly. Okay. So that's the thing. So the Fed is really trying to kind of walk this really fine line. The Fed has made it very clear that the primary concern is stamping out inflation.
Yep.
And the reason why that's important to you and I is because inflation is the biggest thief. Okay?
Yeah.
And the reason inflation is the biggest thief is because when we have inflation, everything costs more. So that is more money coming out of our pocket for the same goods and services that we were paying less for just yesterday.
Unless you have a massive real estate portfolio, you can raise your rents, charge more money, and then pay for the goods and services with inflation adjusted rent money.
Well, there's a whole other story about that. But so,
Okay.
This is kind of what the Fed's trying to walk, and so that's why I've got this big concern about regional banks, because that domino effect will spill into residential, and it will spill into all of our lives regarding inflation. So all of this kind of comes, full circle.
Here's the thing. Here's my summary. The thing that I like the best about the mess. This has been a mess the last year with inflation, with spending, with high interest rates. And with all of these negative things, the housing market has performed pretty damn well, residential housing. It's performed pretty damn well. The banks, the regional banks it's going to be ugly potentially. There could potentially be a recession. There could potentially be office, industrial, commercial, REITs and stuff, real estate investment trusts, which are non-residential. These tend to be a different asset class of real estate that could do really bad. Mm-hmm. And this whole time, residential real estate will just kind of chug along.
Residential real estate tends to chug along because it's powered by consumers. It's powered by all of us who have to go to the grocery store, who have to go to work, and just live our lives. The rest is much more complex. But, our simple lives are kind of what keep our economy together, what keep the whole country together.
Here's the funny thing. This is actually funny. If you think about the housing crash that we had before 2008, it was the overbuilding of housing and then the massive foreclosures that caused the collapse of housing that then drug the banks down because they had, done all this extra trading, credit, mortgage, credit default swaps on all the mortgage securities. So they were all, all in on this A paper that wasn't A paper, and It really crushed the banks, right?
But this is all happening again, except this time.
Yeah, but it's in reverse. Now we have the bank. We have all the real estate, which is either backed by cash or really, really low interest rates, and then the banks bought all that paper, and now the paper's worth less. Not the homes aren't worth less. The homes are whatever the homes are worth isn't relevant. Because it's the paper that's worth less, because it's the mortgages that they're based on. Mm-hmm. So now the banks have gotten themselves in a real estate problem, but this time real estate doesn't affect the banks because real estate prices fall. It affects the banks because of all the interest rates, low interest rates, and the cash that's backing the market right now. So the real estate doesn't really fall, but now the banks are stuck kind of holding the bag of years of people with getting all these houses for cheap money that now won't ever sell them. We'll never sell these houses.
Right. Well, but the banks, like I said, are also in this pickle regarding the commercial real estate, and that's something to really watch.
Yeah, we're going to talk as we follow the residential market. We're going to look at some of the broad macroeconomic factors that are that affect real estate and how they affect real estate. And not so much commercial. We just want to talk about this. When I saw the 1.5 trillion number, that really got my attention.
Right.
Yeah.
So if you are interested in commercial, drop us a note, because maybe we will do something about commercial. But otherwise, thank you for watching. We appreciate it. Thank you for going down this rabbit hole with us regarding the regional banks. Please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.